recognize the risk of cryptocurrencies. Alright, so you're excited to jump on the crypto wagon, perhaps because you can expect, like a gigantic return, profit on your investment. That's basically the reward for investing. However, you can consider, return without also looking at the risk. Risk is the uncertainty surrounding the actual return that you're gonna generate. So in our investment education purposes, we spend a lot of time, speaking about risk and how everyone should approach it like individually. What may represent high risk for me may not be as risky for you due to our unique lifestyles and financial circumstances. Cryptocurrencies have shown their fair share of volatility, which has made some, investors millions of dollars while wiping out some others' initial investment. So in this video, we'll look at cryptocurrencies price volatility from 2017 to 2018. We'll also define cryptocurrency rewards and risk, describes different types of risk, and give you pointers on managing risk. Let's review the cryptocurrency returns. Different assets generate different types of returns. For example, one source of return is the change in the investment's value. Also, when you invest in the stock market or forex, foreign exchange market, you may generate an income in the form of dividends or interest. Investors call these two sources of return capital gains or capital losses and current income respectively. Although most people invest in cryptocurrency market for capital gains, some cryptocurrencies actually offer current income opportunities. You get an introduction to cryptocurrency returns in the last chapter, which is chapter 2. So let's talk about capital gains or losses. The most popular reason for crypto investing is to see the gains in the coin's value. Some people associate the coins with precious metals such as gold. Doing so makes sense because just like gold, a limited amount is available for most cryptocurrencies. And one way to extract many of them is to mine. Of course, you don't need to gear up with a pickaxe and a headlamp when mining cryptocurrencies. With that, many investors consider cryptocurrencies to be an asset even though they're technically currencies that can be used in transactions. People buy these cryptocurrencies in hopes of selling them when the price rise more. If the value of your cryptocurrency token goes higher from the time you purchase, you get capital gains. When you sell the token, congrats. If the price go lower, you end up with capital losses. So, income. Income is a lesser known type of return in the cryptocurrency market. So, income is generated from something called crypto dividends. Traditionally, dividends occur when public companies distribute a portion of their earnings to their shareholders. So traditional types of dividends include cash payments, shares of stock, or other property. Earning dividends in a crypto market can get a little bit more complicated because different currencies have different operating system and their own rules and regulations. However, the concepts still remain the same. Crypto dividends payments are becoming increasingly popular among altcoins, which are the alternative cryptocurrencies. So altcoin means alternative cryptocurrencies. So besides Bitcoin. When choosing a cryptocurrency for your portfolio, you can consider looking into crypto dividends as well as the potential of capital gains discussed in the preceding topic. Some of the most popular ways to earn crypto dividends are: number one is staking, holding a proof of stake coin in a special wallet, or number two is buying and holding a crypto in any wallet. So at the time of writing, some dividend-paying cryptocurrencies include Neo, Qcoin, Bridgecoin, Neblio, and Komodo. Find out more about these cryptocurrencies in the next video. Alright, so let's go over the risk. Flipping the other side of the coin. So investment returns are, of course, it's exciting, but you can consider return without also looking at the risk. The sad truth about any type of investment is the greater the expected return, the greater the risk. Because cryptocurrencies are considered riskier than some other assets, they may also provide higher returns. The relationship between risk and return is so-called risk-return trade-off. Cryptocurrency investing isn't a get-rich-quick scheme. You shouldn't invest in cryptocurrencies by using your life savings, or taking out a loan. You must consider your risk tolerance, understand the different sources of cryptocurrency risk, and then develop an investment strategy that's suitable for you. Just you, not anyone else, because you're unique, and so is your financial situation. Also keep in mind that early Bitcoin investors waited years to see any returns. If you don't have the patience required, to see any meaningful returns on your investment, you may need to forget about investing altogether. Alright, let's talk about glimpsing cryptocurrencies reward versus risk. One of the main reasons cryptocurrency investing became such a hot topic in 2017 was the crazy surge in the value of major cryptocurrencies such as Bitcoin. Although you may have heard of Bitcoin the most, it wasn't even among the 10 best performing crypto assets of 2017. Bitcoin's value grew by more than 1,000%. but other lesser known cryptocurrencies such as Ripple, which is XRP, and NEM were among the biggest winners with a whopping 36,000% and 29,000% growth, respectively. So where did Bitcoin stand on the performance list? 14th. These returns made investors and non-investors alike super excited about cryptocurrency market. By the beginning of 2018, almost everyone you knew, your doctor, your rideshare driver, perhaps even your grandmother, was probably talking about Bitcoin, whether or not the person you had experience in any sort of investing. I mean, however, as is true of any type of investment, what goes up must come down. So including cryptocurrency market, because the cryptocurrency prices had gone up so much so quickly, the crash was as hard and as speedy. For example, by February 2018, Bitcoin had dropped to the 3-month lows of $6,000 from the highs of nearly $20,000. So the cryptocurrency then started to consolidate above $6,000 support level, forming lowering highs, as you can see in this figure right here. So I'm talking about a price that market has had difficulty going lower than in the past. So in this case, the price had difficulty breaking below $6,000. So back in November 2017, lower highs are those mountain-like peaks on the chart. Every peak high is lower than the previous one, so which indicated a decrease of popularity among market participants. So I talk about support and its cost and resistance in the next chapter of this video. So, many analysts consider the great appreciation of major cryptocurrencies' value to be a bubble waiting to be burst. This fluctuation is a heck of a roller coaster ride in such a short period of time. The returns were great for those who invested early and took profit at the highs. But just imagine investing in a market when the prices were up and watching the value of investment going lower and lower and lower. That's one of the major risk factors in any type of investing, especially in cryptocurrencies. So let's dig into different kinds of risks. So getting educated about risk puts you right on top of your game. Knowing your risk tolerance, you can create a strategy that protects you and your wealth. The risks associated with cryptocurrencies come from many different sources. Here are the various types of crypto risks. Crypto hype risk. Though getting hype up in the thought of buying your dream car like Lambos is a good thing, the hype surrounding cryptocurrencies isn't always as exciting. The main reason that cryptos have a lot of hype is that most people don't know about what they are investing in. They just end up listening to the crowd, and the crypto hype back in 2017 was one of the many drivers of the fast and furious market surge. After people started to figure out what they invested in, the prices crashed. This type of behavior became so popular among crypto geeks that they created their very own lingo around it. Here are a few terms. Number one is FOMO. This crypto geek term stands for fear of missing out. This happens when you see a massive surge in crypto you don't own, and then you hurry to get your hands on it as the price goes up. Hint, don't do it. What goes up must come down, so you may be better off waiting for the hype to calm down and buy at lower prices. Next is food. This is short for fear, uncertainty, and doubt. You can use this in a Reddit post when you hear one of those, Dr. Doomsday talking down the market, like JP Morgan Chase CEO Jamie Dimon spread one of the biggest foods in September of 2017 by calling Bitcoin a fraud. In January 2018, he said he regretted saying that. So the next one is ATH, short for all-time high. So whenever the price of an asset reaches the highest point in its history, you can say it reached an ATH. Next is bag holder. You don't want this to be your nickname because bag holders are those investors who bought out of FOMO at an all-time high, which is ATH, and miss the chance of selling. Therefore, they are left with a bag of wallet filled with worthless coins. So next one is BTFD. This one stands for buy the effing dip. So in order for you not to become a bag holder, you got to buy the effing dip. So before falling for market noise, arm yourself with knowledge on specific cryptos you're considering. You have plenty of opportunities to make lots of money in the crypto market. Be patient and acquire the right knowledge instead of betting on current hype. An investor who trades on the hype probably doesn't even have an investment strategy unless you call gambling a strategy. So you can find different methods of strategy development in parts 2 and 4 of this video. So let's talk about security risks. There's scams, there's hacking, there's theft. These issues have been common theme in the cryptocurrency market since Bitcoin inception in 2009. And with each scandal, the cryptocurrency's values are compromised as well, although temporarily. Your cryptocurrency can be compromised in 3 main ways, which I will outline in the following sections. So you should definitely follow safety precautions in every step of your cryptocurrency investing strategy. Safety check number 1 is the cryptocurrency itself. Safety check number 2 is the exchange on where you're gonna be buying the cryptocurrencies. Safety check number 3 is your wallet. Is your wallet secured? All right. So we'll talk about volatility risk in the next video.